Today we're delving into a topic that's been making headlines and causing concern among economists and homeowners alike: the looming housing crisis. Many indicators are pointing towards an unsettling reality, one that eerily resembles the events leading up to the 2008 housing market crash. But how did we get here, and what can we expect in the near future? Before we dive into the specifics, let's take a moment to understand the gravity of the situation. Over the past few years, the housing market has experienced an unprecedented surge in prices, with home values skyrocketing at an alarming rate. This surge has left many potential buyers struggling to enter the market, while existing homeowners have seen their property values soar. While on the surface, this might seem like a sign of a robust economy, beneath the surface lies a precarious imbalance. Factors such as low interest rates, high demand, limited housing supply, and speculative investments have created a perfect storm, mirroring the conditions that preceded the infamous 2008 housing crash. The ramifications of a potential housing crash are far-reaching and could impact not only homeowners, but also renters, financial institutions, and the overall economy. Understanding the factors contributing to this situation is crucial to prepare for what might lie ahead. Throughout this video, we'll be examining these factors in depth, exploring the economic indicators pointing towards an impending crisis, and discussing expert opinions on what measures can be taken to mitigate the risks. Stay tuned as we navigate through this complex and concerning landscape. So buckle up as we uncover why many believe that the upcoming housing crash could potentially surpass the impact of 2008. Don't forget to subscribe and hit the notification bell to stay updated on this critical issue. Let's get started. In order to grasp the severity of the looming housing crisis, it's essential to draw parallels between the current state of the housing market and the infamous crash of 2008. While history doesn't always repeat itself, there are striking resemblances between the two periods that demand attention. The 2008 housing crash was a seismic event, triggering a domino effect that led to a global financial crisis. It was characterized by a housing bubble burst, subprime mortgage defaults, and the collapse of major financial institutions. Fast forward to today, and we're witnessing a housing market that's displaying eerie echoes of the past. Both eras share commonalities such as rapidly escalating home prices, a surge in speculative investments, and a reliance on risky lending practices. Back in 2008, subprime mortgages and inadequate lending standards were major contributors to the crisis. Today, similar concerns have resurfaced, albeit under different names, with a rise in non-traditional mortgages and an increasing number of borrowers stretched thin financially. What sets the current scenario apart is the interconnectedness of the global economy, technological advancements, and the lessons learned from the previous crisis. Yet, questions linger. Are we better equipped to weather a potential housing market downturn this time around? And how might this impending crisis compare to the aftermath of 2008? In this video, we'll delve deeper into these questions, analyzing the strengths and weaknesses of our current economic landscape compared to 2008. Understanding these parallels and disparities will be instrumental in preparing for the potential fallout of the looming housing crisis. As we delve deeper into the impending housing crisis, it becomes imperative to dissect the factors fueling the escalating housing bubble. The current state of the housing market isn't solely a result of organic growth. Rather, it's a complex interplay of various contributing elements that have propelled prices to unprecedented levels. One of the primary drivers behind this housing frenzy is the persistently low interest rate environment. The Federal Reserve's accommodative monetary policy has kept borrowing costs at historic lows, incentivizing borrowing and fueling demand for real estate investment. Another contributing factor is the constrained supply of homes. Builders have struggled to keep up with the demand due to various reasons such as labor shortages, regulatory hurdles, and rising material costs. This imbalance between supply and demand has created a seller's market, where prospective buyers face bidding wars and limited options, further exacerbating the housing affordability crisis. Speculative investments characterized by flipping houses or purchasing properties purely for investment purposes, have also played a significant role. This influx of speculative activity has inflated prices beyond fundamental value, raising concerns about a potential bubble burst. Moreover, the growing trend of non-traditional mortgages and an increasing number of borrowers with high debt-to-income ratios are worrisome indicators reminiscent of the pre-2008 era. As concerns mount over the stability of the housing market, a closer examination of key economic indicators reveals warning signs pointing towards a potential crash. These indicators, often considered barometers of the market's health, offer valuable insights into the underlying vulnerabilities that could trigger a significant downturn. One such indicator is the sharp increase in housing prices surpassing income growth and inflation rates. This unsustainable trend has raised red flags among economists and policymakers, signaling a potential housing bubble. According to experts, when housing prices detach from the fundamental factors like income growth and inflation, it creates a situation where affordability becomes a major concern. If this trend continues unchecked, it could lead to a market correction. Additionally, the rapid surge in mortgage debt and the proportion of high-risk mortgages being issued are causes for apprehension. The rise in non-traditional mortgages and high debt-to-income ratios among borrowers poses a systemic risk. Another critical economic indicator to consider is the Federal Reserve's monetary policy. The potential tapering or normalization of interest rates after a prolonged period of low rates could significantly impact the housing market. Moreover, employment trends and wage growth play a pivotal role in the housing market's stability. A sudden downturn in the job market or stagnation in wages could weaken consumer confidence and impact home buying activity. Policy and regulation wield significant influence over the dynamics of the housing market. Government interventions, regulations, and economic policies play a crucial role in shaping the market's stability and mitigating risks associated with potential downturns. One fundamental aspect of policy in the housing market is the regulation of lending practices. Stringent regulations introduced after the 2008 financial crisis aim to prevent risky lending behaviors and ensure borrowers' ability to repay their mortgages. According to an economist, regulations such as the Dodd-Frank Act have imposed stricter guidelines on lenders, requiring them to verify borrowers' income and assess their ability to repay loans. These measures were put in place to prevent the type of irresponsible lending that contributed to the previous housing crash. However, some argue that while these regulations aimed to enhance stability, they might have inadvertently constrained credit access for certain demographics, affecting housing affordability. Policies regarding land use and zoning also influence the housing market. Restrictions on land development and zoning laws can limit the supply of housing, exacerbating affordability challenges in high-demand areas. Additionally, government intervention through fiscal policies, such as tax incentives or subsidies for home ownership, can impact housing demand and influence market behavior. The impending housing crisis isn't just a matter of market fluctuations. Its repercussions extend far beyond, affecting homeowners, renters, and the broader economy. Understanding the multifaceted impact of a potential housing crash is crucial in comprehending its widespread implications. For homeowners, a housing market downturn could mean a decline in property values, eroding the equity they've built in their homes. This could lead to negative equity, making it challenging to refinance or sell their properties. Furthermore, for those planning to enter the housing market, a crash could present an opportunity. However, stringent lending criteria and market uncertainty might hinder their ability to purchase homes. Renters, on the other hand, might face a dual challenge. While a housing crash could potentially lead to lower rents, it could also disrupt their living situation if landlords face financial strain or foreclosure. Zooming out to the broader economy, a housing market downturn can have ripple effects, It impacts industries tied to housing, such as construction and real estate, leading to job losses and reduced economic activity. According to a senior economist, the housing market is intricately linked to the overall economy. A significant downturn can dampen consumer spending, reduce confidence, and have far-reaching consequences on various sectors. As the specter of a housing market downturn looms, experts and analysts have been scrutinizing the indicators, assessing risks, and offering forecasts for what the future might hold. Their insights and predictions provide valuable guidance in navigating the uncertainties ahead. Renowned economists, housing market analysts, and financial experts have been weighing in on the potential trajectory of the housing market. While opinions vary, there's a consensus on the need for vigilance and preparedness. An expert told us, "Given the current trends in housing prices and lending practices, there's a heightened risk of a significant correction in the housing market within the next 12 to 18 months. While another expert said, "I'm cautiously optimistic that we won't experience a crash similar to 2008, but a moderate downturn in certain regions with inflated prices is probable." Some experts point to factors such as government interventions and the adaptability of financial institutions as potential mitigating factors that could prevent a full-scale crisis. Conversely, others express concerns about the fragility of the market, warning of the potential for a severe correction due to unsustainable price levels and risky lending practices. Another senior expert said, "The housing market is showing signs of overheating, with prices reaching levels that are detached from economic fundamentals. If left unchecked, it could lead to a painful correction." Despite varying forecasts, the overarching message from experts underscores the importance of preparedness, prudent financial planning, and regulatory vigilance. As concerns regarding a potential housing market downturn persist, implementing strategies to mitigate risks becomes paramount. Whether you're a homeowner, a prospective buyer, or a renter, there are proactive steps that can be taken to navigate through uncertain times. For homeowners, maintaining financial resilience is key. Building and maintaining a healthy emergency fund can provide a buffer against unexpected financial shocks, especially in the event of declining property values. Most financial advisors say, an emergency fund equivalent to at least 3 to 6 months' worth of expenses can provide a safety net in case of job loss or unforeseen expenses, helping homeowners navigate through a housing downturn without risking foreclosure. For prospective buyers, thorough financial planning and realistic budgeting are crucial. Assessing affordability and ensuring a comfortable financial cushion before entering the housing market is essential. Additionally, diversifying investments and avoiding over-leveraging in real estate can safeguard against significant losses in case of a market downturn. According to a financial advisor, a diversified investment portfolio reduces exposure to the volatility of any single asset class. Don't overcommit to real estate investments, especially if it might strain your overall financial situation. Renters facing potential housing instability should explore rental protections and understand their rights in the event of landlord foreclosure or property sale. As we conclude our exploration of the looming housing crisis, it's evident that the future of the housing market remains uncertain. The convergence of various factors has created a landscape fraught with risks, prompting the need for preparedness and caution. Maintaining financial resilience, exploring refinancing options, realistic budgeting for buyers, and understanding legal protections for renters are pivotal strategies in preparing for potential market shifts. It's essential to remain vigilant, monitor market trends, and stay informed about policy changes that could impact the housing landscape. Whether you're a homeowner, a prospective buyer, or a renter, taking proactive steps and being prepared can provide a sense of stability and resilience in the face of market volatility. Our exploration today serves as a reminder that while the housing market's future may be uncertain, informed decisions and prudent financial planning can mitigate risks and pave the way for a more secure future. Thank you for joining us on this critical analysis. Stay informed, stay prepared, and remember to subscribe to our channel Escalating Wealth for future updates on navigating the ever-evolving housing market landscape.